All right, so you're looking for knowledge, right? You want it fast,
Yeah.
and you definitely don't want to wade through a ton of fluff.
Well, that's exactly what we do here on the Deep Dive. We kind of like cut to the chase and give you those insights you need, no time wasted, skip all that endless reading and all that.
Exactly. We're all about extracting that pure, concentrated knowledge that really makes a difference. And today we're diving deep, really deep, into a true classic in the world of investing. You ready for this?
I'm ready. Ship me.
Benjamin Graham's The Intelligent Investor.
Oh, now that's a big one.
It really is. And we've gone all out. We've got excerpts from all over the book, commentaries, even those appendixes, all to make sure you're getting a complete picture of what Graham's all about.
It's like we're unlocking the secrets of intelligent investing, right?
Hey.
But it's not just a dry summary. We're going to pull out those little gems, those surprising facts, the stories that stick with you, the stuff that makes Graham's advice really hit home.
Totally. We want you to walk away, or I guess drive away, with a solid understanding of how Graham saw the path to building wealth. And it's amazing.
What's that?
His advice, as old as it is, it's still incredibly relevant today.
Oh, for sure.
This edition, it's got commentary up to 2003, so it's fascinating to see how his ideas hold up through all those market swings and changes.
So like timeless wisdom,
There's actually a note in here, and it talked about how Graham, well, he wouldn't have been surprised at all by that whole dot-com boom and bust.
Really?
Yeah. It's because he had already seen something similar, like way back in 1919 with his company called Savile Tire.
Savile Tire? What happened there?
Oh, it seemed promising at first, but it turned out to be like a complete fraud.
Wow.
And, it just highlights how these market bubbles, these crashes, they're not new. It's like human behavior, especially in the market. It kind of keeps repeating itself.
It's like history rhyming, as they say.
Exactly. And Graham, he started on Wall Street back in 1914. So he lived through a ton of these cycles firsthand. He saw the dangers of getting caught up in speculation, and he knew that the real rewards, they came from being disciplined and analytical.
Yeah, that's a really important point. He provides a framework that helps cut through all the hype and all the noise, no matter what era you're in. So let's get down to it. What does it even mean to be an intelligent investor? It's right there in the title, right? But Graham, he wasn't just talking about, having a super high IQ or something.
Oh, absolutely not.
It was much more about your character.
Right.
Your patience, discipline, that real eagerness to learn, keeping a cool head when everyone else is losing theirs in the market. And this is huge, thinking for yourself. It's not about being a genius. It's about who you are as an investor.
Yeah. I love that he levels the playing field. You don't need to be some kind of financial wizard to be successful.
Nope, not at all.
It's about building the right mindset and sticking to a rational, evidence-based approach.
And he's very clear about separating investing from speculating.
Yes, absolutely.
So for Graham, investing, it's all about protecting your money, your principal, and aiming for a solid return over the long term.
And you get there by doing your homework,
Yeah.
really analyzing those investments.
Exactly. And then you have speculation, which, well, it's often driven by this hope of getting rich quick without necessarily doing all that in-depth analysis.
Right. It's almost like gambling, right?
He actually uses that analogy. He says investing is like a special casino where if you follow the rules being Graham's principles, of course, the odds are in your favor.
I like that.
But speculation, that's like your typical casino where the house always wins in the end.
So understanding that difference, that's crucial.
Oh, it's the first step to becoming an intelligent investor, for sure. And it's interesting, Graham points out that, the financial industry, they subtly push those speculative activities.
Really? Why would they do that?
Well, because those quick trades, those risky bets, they generate a lot more fees for them.
Ah, I see. It's all about those transactions.
Exactly. Much more so than that steady, long-term approach of, true value investing.
So recognizing that difference, being aware of those motivations, that's a huge advantage for you.
Absolutely. Now let's talk a bit about market history. Graham, he really stressed the importance of understanding market cycle, those ups and downs that happen over time.
Yeah, those are inevitable, aren't they?
Oh, absolutely. And he was adamant about one thing. Bull markets, those periods of nonstop rising prices, they always end.
Yeah, what goes up must come down, right?
Exactly. And often it doesn't end pretty. He pointed to the 1970 market crash and later, of course, the dot-com bubble bursting in the late 90s, early 2000s.
Right. And even today, people forget those lessons so easily.
It's like we have short memories when it comes to market history. But Graham knew better. He saw how dangerous it was to believe that you could buy any stock at any price and just, ride it to riches.
Especially those hot stocks, right?
Yeah.
Everyone wants to get in on the next big thing.
Exactly. But he understood that the market, it has a way of like snapping back to reality. Those big drops, they're not flukes, they're a normal part of the cycle.
So don't get too caught up in the hype.
Exactly. Now, here's something really fascinating. Graham noticed a pattern in how certain market strategies, even ones that worked well for a while, they eventually stopped being effective.
Interesting. Like what?
Well, he talks about a formula he himself developed for trading based on the Dow Jones Industrial Average, the Dow.
Yeah, sure.
And it worked great for a while, but after 1949, it stopped being as reliable. And he saw the same thing happen with the Dow theory, which, was a pretty popular method back in the day. After 1934, its track record just wasn't as impressive.
So what's the takeaway there?
I think it's a reminder that what worked brilliantly in the past might not be the best strategy for the future.
Right. Things change.
Exactly. You can't just blindly rely on past performance or follow the latest investing fads. The market's constantly evolving, and what might have been a solid indicator, a money-making tactic, it can lose its edge.
Especially as more people catch on.
Right, exactly. Now let's talk about one of Graham's most important ideas, his big contribution to the world of investing, the margin of safety.
Ah, yes. The margin of safety. So how can we, break that down for our listeners?
So imagine the margin of safety is like your financial airbag when you're investing. It's that cushion that protects you if things don't go exactly as planned.
Okay, I like that.
So it's the difference between the price you pay for a stock and what that business is actually worth, its intrinsic value.
Right, and figuring out that intrinsic value, that can be tricky.
Oh, it definitely is. And that's exactly why Graham considered the margin of safety so important.
Because you might not always get that valuation perfect.
Exactly. And even if you're pretty close, unexpected stuff can happen,
Yeah.
right?
Stuff you just can't predict.
Exactly. So the margin of safety, it helps protect you from those errors in judgment and those unforeseen events.
It's like that extra layer of protection.
Right. Now, he even linked this concept to the relationship between a stock's earnings yield, which is basically how much a company earns compared to its stock price, and the interest rates you get on bonds.
Interesting. So how did those two things connect?
Well, back in 1972, he pointed out that at that time, stocks actually had a negative margin of safety compared to bonds.
A negative margin of safety. What does that even mean?
It meant that the earnings yield on stocks, it was lower than what you could get from investing in, relatively safer bonds. And to him, that suggested stocks as a whole were probably overvalued.
So bonds are actually the better deal at that moment.
According to his analysis, yeah. And this leads to his core advice, which was aim to buy stocks when they're trading at a significant discount to their intrinsic value.
Kind of like finding those, dollar bills for 50 cents.
Exactly. He called it finding 60-cent dollars. I love that. And the idea is that even if you're not 100% spot on with your valuation, that bargain price gives you that safety net.
Exactly. You've got that cushion built in. Now, Graham recognized that not all investors are the same.
Right. We all have different goals, different risk tolerances.
Totally. So he outlined two main types of investors.
Okay, let's hear about these two types.
All right. So first you have the defensive investor. This is someone who prioritizes safety and simplicity above all else. They want decent returns, but they don't want to spend all their time obsessing over the market or doing, complex analysis.
Sounds like a pretty hands-off approach.
Exactly.
Huh?
So if you prefer a more laid-back style, you want to minimize your chances of losing big, this might be the path for you.
All right, so what about the other type?
The other type is the enterprising investor.
Okay, tell me more about them.
All right, so the enterprising investor, they're willing to put in more time, more effort, really dig into the research and analysis.
And they do that because they're aiming for potentially higher returns. They're okay with a bit more complexity, a bit more risk, as long as it's calculated.
So they're more active, more hands-on.
Exactly. Now, for our defensive investors out there, those who prefer that less active role, Graham had some very specific recommendations.
Okay, I'm all ears. Let's hear those recommendations.
He said, focus on buying stocks of large, well-established companies, the kind that are conservatively financed and have a long history of consistently paying dividends.
Solid, dependable companies.
Exactly. And he even gave some benchmarks for what he considered conservative financing. Like, for industrial companies, he said their common stock equities should be at least half of their total capitalization. And for utilities and railroads, at least 30%.
Wow, those are some specific guidelines.
Yep, he really spelled it out. And of course, he also emphasized the importance of diversification.
Right, not putting all your eggs in one basket.
Exactly.
Yeah.
Spreading your investments across different companies, different industries, and he also recommended dollar cost averaging.
Now, that one always comes up. Can you explain what that is?
Sure. So with dollar cost averaging, you invest a fixed amount of money at regular intervals, whether the market is up or down.
Okay, so you don't try to time the market.
Exactly. You just stick to your schedule.
And that helps you
Because you end up buying more shares when prices are low and fewer when they're high. So you're averaging out your purchase price over time.
it's like taking the emotion out of it.
Exactly. Now, for those defensive investors who don't want to be too hands-on, he also suggested a couple of other options.
Oh, like what?
He said you could consider investing in well-established investment funds.
So like mutual funds.
Exactly. Or you could seek guidance from a trusted financial advisor.
So you have someone else managing your investments for you.
Right, especially if you're not comfortable doing it all yourself. Now let's switch gears and talk about our enterprising investors, those folks who are willing to roll up their sleeves and do some digging.
Okay, so what kind of opportunities did Graham see for them?
Well, he pointed to a few potential avenues for higher returns.
All right, let's hear about those.
One was what he called bargain issues.
Bargain issues. Okay. What are those?
These are stocks that are trading at a price that's lower than their net working capital.
So the company's assets are worth more than what you're paying for the stock.
Exactly. It's like getting a business on sale. And he also talked about special situations.
Okay, what makes a situation special in the investing world?
Think things like potential mergers, acquisitions, or even liquidations.
So events that could significantly impact the company's value.
Exactly. And these situations can sometimes create opportunities for substantial gains if you know what to look for.
But I'm guessing there's more risk involved too, right?
Oh, absolutely. He was very clear about that. These areas, they come with greater risk. And as more investors catch on to these strategies, the potential for those big profits, it might shrink over time.
Right, because the competition heats up. Now, what about those so-called growth stocks? I feel like those are always in the news.
Oh, yeah. But Graham, he was pretty cautious about them, especially for the average investor. He saw them as inherently more speculative and more vulnerable to those big price drops.
Even if the company is doing well.
Even then. He used examples from his time, like IBM and Texas Instruments. They both experienced huge growth, but then, bam, their stock prices took a hit.
So past performance isn't always a guarantee.
Exactly. And in the later editions, they even drew parallels to more recent examples like Microsoft and Cisco during the dot-com bubble.
Oh, right. They were seen as like can't miss investments and then
the bubble burst.
So what's the lesson there?
It's that even if a company has a ton of growth potential, it doesn't automatically mean you're guaranteed to make money as an investor.
You still have to be careful about the price you pay.
Exactly. The price always matters.
All right. So when you were evaluating stocks, Graham stressed looking beyond just the most recent earnings report, right?
Oh, absolutely. He said, don't get too caught up in the hype of the latest quarter or those super optimistic projections about the future.
So don't just focus on the short term.
Right. Instead, he said, look at a company's price-to-earnings ratio, but don't base it just on this year's earnings or next year's projections.
So how do you do it?
He said, consider the average earnings over several years.
So get a bigger picture.
Exactly. It gives you a more stable and realistic picture of the company's profitability.
And it helps you avoid overpaying just because the company had one good year.
Right. He really cautioned against relying too heavily on those next year's earnings projections.
Which Wall Street loves to talk about.
Oh, they love those projections. But Graham saw them as way too speculative, way too prone to wishful thinking.
So stick to the facts, the historical data.
Exactly. Now let's talk about how to handle those inevitable market fluctuations. We've all seen them, right? The ups and downs, the roller coaster ride.
Yeah, it can be scary. And a lot of people try to time the market, buy low, sell high.
Oh yeah, that's the dream.
Yeah.
But Graham was firmly against that. He said, don't even try to time the market.
Really? But that's what all the experts seem to do.
Yeah, but he pointed out that even those professional forecasters, the so-called experts, they get it wrong all the time. He even mentioned Alan Greenspan.
The former Fed chairman.
Yep, the same guy. Even he gave some super optimistic predictions right before a major market downturn.
So if you can't time the market, what do? Just sit back and watch it go up and down?
Well, not exactly. Graham believed that you should aim to benefit from those market changes, but without getting caught up in speculative activities.
So don't try to predict the short-term swings.
Right. And he said if you do choose to speculate, be honest with yourself about it, and only do it with a limited amount of money that's totally separate from your long-term investment.
Okay, so keep your gambling money separate.
Exactly. Now, he saw those big market drops as potential buying opportunities.
Because prices are lower.
Exactly. A chance to buy good companies at more attractive prices. And conversely, when the market's way up, he saw that as a time to maybe consider selling if your investments have become overvalued.
So take some profits off the table.
Yeah, but for most of the time, when the market's just doing its normal thing, he said focus on the dividends you're receiving and how well those companies are performing.
So stick to the fundamentals. Now, Graham also had some thoughts on how you should measure your own investment success.
Oh, yeah, and this is an important one. He said, don't constantly compare yourself to others.
Right, don't get caught up in that keeping up with the Joneses mentality.
Exactly. He saw that as a recipe for anxiety and bad decision-making.
Like chasing those hot stocks everyone's talking about.
Right, or taking on too much risk just to try to match someone else's returns. He said your focus should be on meeting your own investment goals, sticking to those sound investment principles.
So run your own race.
Exactly.
Yeah.
Now let's talk about investment funds.
Okay, like mutual funds.
Yeah, things like that. Graham actually made a distinction between two types, open-end and closed-end funds.
Okay, what's the difference?
So open-end funds, they can issue new shares and redeem existing ones every day.
So they're more flexible.
Right. And they often trade at or slightly above their net asset value.
Meaning you're essentially paying full price for the underlying assets.
Yep. And closed-end funds, they have a fixed number of shares.
So it's like buying a piece of a static pie.
Exactly. And these often trade at a discount to their net asset value.
So you might be able to get a bargain.
Potentially, yeah. Now, when it came to actually selecting funds, Graham was a bit skeptical.
Skeptical about what?
About whether you could consistently pick funds that would outperform the market just based on their past performance.
Right, because past performance doesn't guarantee future results.
Exactly. And he pointed out that those really impressive returns, they might actually be a sign that the fund managers were taking on a lot of risk.
The kind of risk that could backfire.
Exactly. And he talked about those performance funds, the ones that really aggressively try to beat the market.
They sound risky.
They can be. He warned about their volatility, how much they go up and down, at the fact that they could even underperform in the long run.
So what did he recommend instead?
Well, he thought index funds could be a decent option, especially for those defensive investors.
Because index funds just track a specific market index.
Exactly. They're not trying to beat the market, they're just trying to match it.
So they're more passive.
Right. And they can work well with that dollar cost averaging approach we talked about earlier.
It's like a set it and forget it strategy.
Kinda, yeah. Now, another big theme throughout the book is the importance of independent thinking and doing your own research.
He really stressed not just blindly following advice. Right?
Oh, absolutely.
Yeah.
He said, don't just take anyone's word for it, whether it's your relatives, your banker, your broker, or even those financial gurus you see on TV.
So do your own homework.
Exactly. He said you need to develop your own understanding of the businesses you're investing in, form your own opinions.
Don't just be a sheep following the herd.
Right. Now, for those who do want to work with a financial advisor, he had some strong advice.
Okay, what was that?
He said, before you hand over your money, do your due diligence.
Investigate the advisor.
Yep. Really check them out. Make sure they're trustworthy, competent, and that their fees are reasonable.
So don't just go with the first person you meet.
Right. And he actually gave a list of specific questions to ask potential advisors, things to help you figure out if they're a good fit.
That's really helpful. Now, he also covered the basics of security analysis. How to actually evaluate a stock.
Yeah, and he emphasized the importance of understanding those financial statements.
The balance sheet, income statement, all that fun stuff.
Yep, the whole shebang. And understanding key financial ratios, which can tell you a lot about a company's financial health.
Right, so you can see how profitable they are, how much debt they have, things like that.
Exactly. And while he acknowledged that security analysis had gotten more sophisticated over time, with all these models that try to project future growth and all that,
He wasn't a huge fan of those, was he?
he was a bit wary of them. He thought they could be too complex, too reliant on assumptions that might not pan out.
So he preferred a more grounded approach.
Definitely. And he pointed out some red flags to watch for in those financial statements.
Like what?
Things like recurring charges that keep popping up but are labeled as non-recurring.
Ah, sneaky accounting tricks.
Right. And excessive borrowing, which he compared to being addicted to other people's money.
Okay, yeah, that's not good.
Nope. And he talked about dividends, how companies should really justify why they're not paying dividends if they're not.
Because dividends are a way for companies to share their profits with shareholders.
Right, exactly. And he was critical of stock splits, when companies divide their shares into smaller pieces.
Which is supposed to make the stock look cheaper.
Right. He saw that as a gimmick, a way to artificially hype up a stock.
So don't be fooled by those tricks.
Exactly. Now, let's talk about the relationship between shareholders and the company's management.
Okay, that's an interesting dynamic.
It is. And Graham really believed that shareholders, they should think of themselves as owners.
Right, not just passive investors.
Exactly. And he said there are ways to evaluate how effectively the management team is running the show.
Okay, like what?
Well, you can compare the company's profitability, its size, its competitive position to similar companies in the same industry.
So see how they stack up against their peers.
Right. And that can give you a good sense of whether the management is doing a good job or not.
And if they're not doing a good job, what then?
Well, Graham said that if a significant number of shareholders believe a change in management is needed, they should be prepared to fight for it.
So be active, be vocal.
Right. Don't just sit back and complain.
Now, he also talked a bit about those big corporate actions, like mergers and acquisitions.
Yeah, he noticed something interesting about those. He said a lot of times the benefits of those deals, they don't actually go to the shareholders of the company doing the acquiring.
Really? Who benefits then?
Often it's the shareholders of the company being acquired.
Ah, so the sellers are the ones who come out ahead.
A lot of times, yeah. And he briefly touched on the topic of stock buybacks.
Which is when companies use their profits to buy back their own shares.
Exactly. It's an alternative to paying dividends.
And there's a lot of debate about whether buybacks are good or bad for shareholders.
Oh, yeah, that's a whole other topic. Now, the book also includes a bunch of case studies. Graham calls them special situations.
Right. We mentioned some of those earlier. Companies like Savile Tire, AOL, Time Warner, and a few others.
Yep, those are just a few examples. And the point of those case studies is to show you how those principles we've been talking about, how they play out in the real world.
So it's not just theory, it's actual examples of how things work.
Exactly. And they highlight the dangers of speculation, how even seemingly solid companies can run into trouble, how market sentiment can get out of whack.
So they're like cautionary tales.
In a way, yeah. But they're also there to reinforce the importance of sticking to those core principles.
Focus on value, demand a margin of safety, don't get swept up in the hype.
Exactly. So as we wrap up this deep dive into the intelligent investor, what's the big takeaway for our listeners?
What's the one thing you want them to remember?
I'd say it's this. Intelligent investing, it's not about luck, it's not about timing the market, and it's definitely not about following the crowd.
So it's about being smart, being disciplined.
Right. It's about understanding a company's real worth, buying it at a discount, and thinking of yourself as an owner, not just a speculator.
And those principles, they're just as relevant today as they were when Graham first wrote the book.
Maybe even more so.
Now, before we go, I want to leave our listeners with something to think about.
All right, hit them with it.
So Graham wrote this book quite a while ago. The world's changed a lot since then.
Oh, yeah. Technology's evolved. Business models are different. The whole landscape has shifted.
Exactly. So my question is, how do you think those core principles of value investing need to be adapted, if at all, for today's world?
That's a good one. Like, how do you apply those principles to, say, digital assets or companies that don't have a lot of physical assets?
Right. And how do you find that margin of safety in a world that's constantly changing?
It's a challenge, for sure, but it's a challenge worth tackling.
Absolutely. So to our listeners, we encourage you to explore the intelligent investor for yourselves. Really dig into those ideas and think about how those principles can guide you in today's market.
It's a book that can truly change the way you think about investing.
Thanks for joining us on this deep dive.